Hey everyone, this is Robert Keens with goldsilverpros.com. It is Thursday, December 10th, 2020. And as you can see, I made it out to my secret hideout gold vault in the mountain just to check up on my gold. Looks like it's doing well. The pallet of gold is resting safely there. I think I'm going to do some skiing a little bit after this video presentation. Maybe ski down the slope to a nice chateau, have some dinner, and just relax for the rest of the evening. All kidding aside, I thought today would be a good day to look back at 2020 and see how the average consumer is doing now that we've had a year of crisis and shutdowns, and get a look at where people are in terms of their savings and their overall wealth. I've got a lot of data to show you on that today, guys. In addition, we're going to take a look at the gold and silver markets and what's going on in December in the second half of the video. Let's go ahead and get started with the consumer, and we'll take a look at what's going on. I'm just going to be going down some data presented in some articles and various resources. I've got an article here on King World News submitted by Daniel DiMartino Booth at Quill Intelligence, former official at the Fed, at the Dallas Fed. She really does a good job. One of the reasons I like following her is with her economic data. I think she does a fantastic job looking at it. She's got a couple of really interesting charts here on the consumer so far. She's got a chart here called credit card spending declined 7 of last 8 months to 3-year low. Of course, that coincides basically with the beginning of the shutdowns. You can see here that the green line here, the credit card borrowing has fallen off a cliff. It's down, just below 10% for the last 7 to 8 months, while at the same time, the personal savings rate has done very, very well. And the overall zero maturity or cash in the system has risen due to people saving and not spending. Of course, it makes sense with businesses shutting down that people would spend less. And it's really interesting that they're paying back their credit cards, trying to pay off some of that revolving debt. That's a really good thing, actually, for financial health, but it also means the economy is not doing so hot with people spending so much less. What's happened as a result of those changes in the economy? Another chart that she has here is the work week, and it's really changed for a lot of people. As you can imagine, the people got hit the worst are the self-employed by this purple line. The self-employed, especially down in March, April, when the shutdowns first occurred, but even as the year has gone on, have not recovered to where they were before. So that means small businesses are not doing as well. And what I've noticed is when I go out to small businesses around me, if I want to do some shopping or go to a doctor's appointment or something, they're reducing their hours. Now, especially doctors and health offices are reducing hours in the middle of the day. They're taking long lunches. They're reducing how many hours they're open on a daily basis. They're cutting weekend hours. A lot of small shops in my area are doing the same thing just because they don't have as many customers. So, by their logic, we don't need to stay open quite as long. The people that have got hit the hardest in terms of how much additional they're working is this blue line here. It's the average everyday worker. People that have full-time, part-time jobs are working more hours than they have all year long because the burden upon that has come upon them. Businesses aren't hiring as much, and they're putting the burden on their workers to work more hours. Managers as well, although the average everyday worker bee is working more hours than their managers. The managers haven't suffered the burden quite as much. So if your manager is complaining about how many extra hours they're working this year, show them this chart from Daniel DiMartino Booth's article and tell them, look, we're working more than you are, and we're bearing the burden of the additional work hours from companies not hiring. At the same time, feel sorry for all those small private businesses that are closing down, and the ones that are staying open are having less sales and a smaller work week, definitely having their overall savings rate affected. Here is from Fred, from the St. Louis branch of the Fed, is the Fred data around personal savings rate. You can see it spiked this year as people really tried to save a large percent of their income, over a third of their income. That's the first time, that's the only time on the chart dating back to 1960 that's ever happened. Look at this spike. This is just such an anomalous spike that when the pandemic hit in April, the savings rate went to over a third. People literally just stopped spending. It was just like shock to the system, stop spending immediately to see what would happen. Now, if we could get people to do that every month, maybe not save 33% of their income, but save a higher percentage of their income, people would be more prepared for the coming economic meltdown, but at least they did respond positively in April. And even though it's come back down quite a bit, it's still at a high of over about 60 years still this year at a high. People are still saving this year, which is kind of a good thing, but it also means that's how many fewer dollars are going into the general economy. And that's why the businesses have been hit so bad, like we showed you in the past chart. Now I want to transition and show you what's happened to U.S. overall household wealth. Article from Zero Hedge here. U.S. household wealth hits all-time highs, top 1%. Have never been richer. Now, the top 1% are doing better, but I'll show you here in a moment. Not everybody's doing better. And then we're going to transition and show you where people have their money and why that is such an outsized risk, given what's about to happen to the economy, we think, in 2021. So here is an interesting chart showing the total change trillions of dollars of wealth that people have had. And you can see the biggest category, the biggest adjustment is always in corporate equity. That's the stock market. And the biggest adjustment for this year has been in corporate equity. So in other words, what people are saving in that grows or shrinks the most when things crash or when they bubble up is in the stock market. So the stock market has one of the highest betas or overall rates of change, meaning from my perspective, it's harder to save in the stock market. You tend to do well during the booms, but you really crash out during the bust, and your overall wealth doesn't grow nearly as much as you think if you're holding during that entire time. It tends to be very volatile market, as you can see these massive swings in the corporate market, the corporate equity market. But also goes to show you people aren't saving in as much other things. They have some bonds, they have some other, they have some real estate. They don't have a lot of gold and silver here or real good tangible assets like farmland or gold and silver. So a lot of this is subject to booms and busts, and that's why people's wealth can evaporate pretty quickly. Of course, the article goes on to note here that on the liability side, total credit rose 3.8% with household debt surging 5.6%. So people are refinancing that mortgage or upgrading to bigger houses and creating more debt for themselves, which is not a good thing. That's the wrong way to go, especially for the real estate bubble. And here is a chart from the Census Bureau on the state of inequality. Of course, the top 5% income grew the most, almost 30%, but the highest quartile grew over 20%, and then you can see it goes down as you go lowest. That is increasing income inequality. And here is a percent change in U.S. real median family net worth by age of head. So the millennials basically are getting slammed a lot. The millennials and my generation, the Gen Xers, are getting slammed a lot. And the people that have made the most are the oldest, the 65 and the 75, probably because they have most of their money in the stock market, but they also have more money in total because they've been saving longer. So the younger generations really have taken more of a hit this year than have the older generations. So if you're young and you haven't had a chance to save yet, this year has really been disastrous for you. Of course, this is a nice chart on holdings of family wealth by group. The top 10%, you can see the wealth has grown tremendously, not only this year, but dating back all the way to the early 90s, while the 50th to 90th percentiles has basically not grown that much since about 1998. That's about 20 years as a total percentage. And the bottom 50% basically has cratered since the last financial crisis, 2008, 2009, and never recovered again. Top 1% are doing the best, top 10% are doing well. The people at the bottom levels are not being able to save at all. And why is that? Well, we're going to look at, we'll get to that moment real quick. Before we do that, we want to look at all the world's wealth. The United States has about 30% of the world's wealth, about 105 trillion, according to this article at Visual Capitalist. You can see about 30% of the global share of wealth. Europe is next at 25.2%, Asia Pacific at 18%. Why is that important? Well, we're going to transition to the next chart. Here specifically in the US, this is majority of families are invested in the stock market. So I want to talk about what people are invested in and by what age group. You can see that about 52% of families are invested in the stock market. Again, the biggest bubble asset. And we'll show how much of a bubble that is here in a moment, why it's so dangerous, and why those people really want to consider getting out of some of the stocks into gold, especially since stock markets are re-hitting all-time highs again. The median holding is about 40% per $40,000 per family in the stock market. And as you can see, as you get older, it shows that 88% of value in the stock market, by family income, but also by age. So the millennials here, the Gen Xers, and the youngest part of the baby boomers have a lot of money in the stock market, more as you get older, of course. So the seniors are going to be most susceptible to a stock market crash, but also by income, as you have more money in general, you're putting more money in the stock market. So in other words, as you make more money, you're throwing it into the riskiest asset right now, which is the stock market. But incredible amount of money in the stock market in the US. And again, 31% of wealth is sitting in the US. What does that mean? You put it all together, most of the wealth creation in the US and Europe has been in the stock market. It's the biggest bubble asset. And the older you are, the more exposed you are to it. That's a disaster waiting to happen, because if you're older and you have a major crash, you have less time to recover from that, but you've got all your money in the most overvalued asset, the biggest bubble asset now, and the one that has the highest beta, the one that has the most violent transitions from bubble bursting to bubble creation. And that's why most people in the US and Europe and these developed countries can't save money, because every time we have a crash, they lose the value of the portfolio, but they're stuck in the system. So they double down and they go more into it. So in other words, even though we looked at the savings rates, and even though the wealth and the saving of the highest net worth individuals has gone up, they're also going to be the ones that get slammed the most when it crashes down. And the people at the very bottom, they're poor, their wealth never goes up. So when we have an economic depression, yes, they'll get hit if they lose their job, but they're not going to lose all their wealth because they're not invested in the bubble asset and stock market. So basically, no matter what age group you are, or percentage wealth in the population, whether you're in the top 1%, top 10%, or bottom 10%, buying a little gold and silver to protect your assets is a really good idea, and to shield yourself from the coming crash that's going to happen. Why is the crash going to happen? That's what we're going to get into next. I have an article from Zero Hedge here talking about call volumes. Call volumes absolutely absurd. Nomura warns sentiment overshoot getting scary ahead of quad witch. I won't get into what a quad witch is, but we're looking at call volumes and overall wealth. Let's look first at the ongoing melt up in the stock market. As Zero Hedge reports, the global market caps are above 100 trillion for the first time in history. So globally, we're in the biggest bubble in the stock market ever in the history of mankind on the planet Earth, according to this data from Nomura. And we're looking at call volumes. What is call volume? So the CBOE prints out a weekly put to call volume ratio. A put is basically a short, a call is going long in its most essential terms. When the put to call ratio falls, like it has here, you see a low number here, it means people are the most bullish on the market because they're going long relative to their shorts more than they have basically since 2000 when we had that big crash. So whenever you see this ratio fall to these levels, we tend to have a crash. You saw it in 08, 09, you saw it in 2000. We're now at the same level in terms of overall exuberance or calls into the market as a percentage of overall options, that people are so exuberant that it looks like from a sentiment perspective, we're headed closer to a crash. And we have more information for you from the Fear and Greed Index and CNN Business. We're in an extreme greed reading on the market, and they use several factors. I've shown this before, but they use stock price strength, the breadth of the market, put in call options. Again, that's the call options ratio we showed you on the previous slide from Zero Hedge and from Nomura, market momentum. So people, in other words, translate this. The global stock markets have hit 100 trillion. People are the most bullish they've been since basically 08 during the last crash and the tech crisis in 2000. And most of people's wealth, especially as you get older and higher income, is in the stock market. What does that mean? It means when the crash comes, most of the people are going to get wiped out, except for the people that have gold and silver. And they have no other investments to protect against it. They're in greed. They're in the stock market. As the stock market marches up, they're throwing all their assets into it. Remember that chart where we showed you that most of the wealth is in the stock market right here. It's in corporate equity. So when this crash comes, people aren't going to have any other safe assets to save them. It's going to crash out most of their overall portfolio. So no matter what income level you are, unless you're the ultra rich and you invest in gold and silver and farmland and things like that, you could get absolutely wiped out in the coming stock market crash. That's going to wrap up the first part of the video. I'm going to come back and show you guys what's happening. Hey everyone, this video has been sponsored by Blue Lagoon Resources. Blue Lagoon is a gold and copper mining company out in British Columbia, Canada. They're in a tier 1 district and have 2 very good gold projects and a copper project in British Columbia You can trade them on the Canadian Stock Exchange under BLLG, on the OTCs here in the US under BLAGF, and on the Frankfurt Stock Exchange under 7BL. Let's talk a little bit about what makes them so attractive. If you're looking to get into the exploration space, they have several projects out here in British Columbia. Of course, they have the Dome Mountain Gold Mine, which is going to be their near-term producer. They have a second gold project in the Polaire project, and also the Big Onion Porphyry Copper project. By the way, copper just hit a 7-year high, trading at $3.52 the other day, and very bullish for people that want to invest in copper. Dome Mountain, which is their near-term gold producer, has 20 kilometers of a productive geological strike. It's only 50 minutes from British Columbia, so it's close to civilization. There's already been $68 million spent previously by this company and the company that had it before in economic development. They have 15 total known veins of mineralization. Only one has been substantially explored and had an economic assessment done on it. 14 more to explore. The company's going to spend money on drilling over 20,000 meters this year to explore those additional veins, and about 90% of this property is blue sky exploration potential they haven't even taken a look at. They've flown over and done some basic in the air studies and surface studies over other parts of that, but there's a lot of expansion potential there. We're going to go down and talk about the Polaire project here, which is their second project. The cool thing about the Polaire project is it has about 25,000 tons of mineralized rock just sitting there from previous mining operations. They don't have to have any permits to use that. They can truck that out. They can run it through the mill, sell that gold, get that money, and help them finance their other projects. But it also has an NI 43-101 technical report on it. It's got 10 mineralized gold and silver bearing quartz veins and varying strike lengths from 100 to 300 meters. Pretty good potential there. Some drill results there that they're looking at that look very beneficial. So it looks like Polaire could be a good secondary project. One of the great things about having a multi-project mining company is they have greater upside potential in the share price. One, as they start releasing news on their Dome Mountain project and also start mining that one, but also having that second project where they're going to get some drill results and continue to increase their resources. That'll increase the overall NAV of the company for those of you that like to do an accounting valuation of companies. Then the third project is the Big Onion Porphyry Copper project. I mentioned just a moment ago, copper hit a 7-year high, which is very good. That's not too far from Smithers either, only a 30-minute drive, and it's a stone's throw from Dome Mountain. As a copper and molybdenum porphyry system, it does have an historical 43-101 report, and it's about 686 million pounds of copper in the indicated category, an additional 64 million in inferred, and there's some additional strike there as well for them to look at and potentially increase their resources. They had, on December 9th, Blue Lagoon came out some really good drill results. They hit 53.76 grams per ton gold over 2.2 meters, including 83 grams per ton gold over 1 meter and 17.69 grams per ton over 3.13 meters at their Dome Mountain Gold project. Still getting really good drill results there. That's a good bit of news. And I recently, earlier this week, did an interview with their CEO, Renavig, which you can see on my YouTube channel. Go here to the Blue Lagoon aggressively expanding their gold ounce video for more information on that. Thank you to Blue Lagoon for sponsoring this video. I think it is a potentially really good value for you guys. It's a developer, so they're low on the Lassonde curve, had a lot of upside potential, have a couple of 43-101 reports, have some existing resources, have a lot of expansion potential, multi-project, as well as having some copper to throw in there as well. I think that could be potentially really good value for you guys. If you're looking to get into the discovery space and want a good gold company that's mining in a tier 1 Canadian gold district, which is a brownfield project, but has some existing ounces in it, it's going to continue to get some news throughout the year, and they're going to continue to develop it with 20,000 meter drill program. Blue Lagoon may be a good option for you. Okay, on to the second part of the video where we talk about gold and silver for December heading into 2021. Stay tuned. Okay, guys, we're back and we're going to look at gold and silver. Let's get right into the data here. Got a relatively short-term gold chart for you, and I'll show you what's going on in gold. It's channel trading right now, but it's also got a bullish channel formation. As you can see, back to about August of this year, it started a downward trend trading in that range, a consolidation range where it pounded through some support levels, the 50-day moving average, the 200-day moving average, but it's come up through the 200-day moving average, challenging the channel high for the second time since it began, looking like it may be ready to enter another bull market. This is often known as a consolidation phase. It usually follows a big move up or down. As you can see, the big move up was here starting in July all the way through August. We had a massive move in gold all the way from high 1700s to high 2000s, about $300 move in gold. And then this consolidation phase down here, where you see a lot of selling, a lot of people taking profits, but it looks like gold's trying to break out of that range. It came up through the critical 200-day moving average. It basically needs to get through the 50-day moving average and stay above that, stay above 1900 for a while, and we are broken that consolidation phase. I think that's bullish for gold. This is a bullish formation, basically textbook bullish formation. So we could stay range trading gold for a little while longer, but I don't think we will. I think by 2021, the trend will continue to be up again as that uncertainty in the market occurs that I showed you in the previous segment of this video. And as the stock market comes crashing down, which it will, because the fundamentals are not great, because the businesses are suffering and overall wealth generated GDP in the economy is down, eventually that stock market's going to come down. Then you'll see the gold price start to shoot up. I think that's what's going to happen. So fundamentally and technically, it looks like things are aligning. Silver, same thing. This is it's a channel formation known as a flag. So again, large rise up in silver. So it's predicated by a large rise up or down. Then you have this flag formation form where you have the support level right at 2250 basically. And you have a silver, by the way, silver never got down to its 200-day moving average. So it was never officially in a bull market. It just broke through the 50, but it stayed around that 50-day moving average. And it looks like it's about ready to break that channel. It's tried once here, so it may come down a little bit and then pop back through the channel. But this flag formation is textbook bullish for silver as well. A lot of consolidation, people taking gains here after a big move up. Looks like it may move up again. So if we do get that aforementioned economic crash in the stock market or continued bearishness with the economy as we continue into more shutdowns and more negative news in the economy, I expect gold and silver to pop through their range trade or their consolidation phase, if you will, that they've had lately. And we'll get back into the bull market. And we've had technical formations form there that looks like we are about to hit another bull market. Will it happen December of this year or January next year? There's no way really to tell, but it looks like both gold and silver are challenging their channel formations. Gold challenging silver's channel. Now they may need to challenge them a couple of times, but it looks like they'll get through. So I expect us to be back in the bull market here in the next month or so. Wanted to look at gold volumes. So the volume has moved in open interest to the February contract. So that's what's determining price. When you have this much volume in a near month contract, or this much open interest, sorry, and this much volume, that is going to determine the price. And looks like we've had quite a few deliveries, 1637 in gold. Let's look at the settlements for gold as of Wednesday, December 9th. The settlements are, as CME Group loads the data, we'll get to that in a minute, but the price is going up. So people are going long in the futures market, 1837.40, 157,000 contracts. And you can see we've got some pretty healthy numbers in the higher prices there as well. Same thing on silver. It is March, which is the heavily traded month, 131,000 open interest and settle of 84,500 on Wednesday, December 9th. And if we look at the overall settlements data, we're going to see that it's fairly bullish in silver, although a little bit of a bearish sentiment today. But 56,000 contracts trading at 24,094 settling in, and a fair amount of contracts trading above that. So again, from the futures trading data, it looks fairly bullish for silver as well going forward. Wanted to look at the overall deliveries because deliveries are an important part of what goes on in the futures market, and gold deliveries have been very strong this month. Month to date, we're at 22,266 contracts of 100-ounce gold. That is a lot of gold. That is basically 2 million ounces, 2.2 million ounces. That's a good amount of delivery in December. And I'll show you here in a moment who's taking delivery. We can see in the commitment of traders data who's going long and who's likely taking the most delivery. I'm going to go down here to the silver futures. So far, we accumulated 8,172 contracts of 5,000 ounce silver. That is a lot of silver. So silver and gold deliveries have been very, very healthy for the month, as we thought they would be. And I think that has part of what's reversing the trend in the price. It seems the slam down came pre-December, then the deliveries came. That's normal. Slam it down prior to the first delivery date. Take delivery. As you get most of the delivery early in the month, then you let the price rise. That's what's happening, and that's why it looks like we're bullish for gold and silver going into the start of the new year. Now we're going to get to the commitment of traders data. I love the bar charts because they give us a time view of that, and you can see who's going long and taking likely delivery in the gold market is the other reportables, as you can see down here, the yellow. And so they're up to almost 200,000 positions. So they're taking delivery of the gold. So it's the other reportables, the wealthy families, the wealthy individuals, family trusts are taking delivery of gold. Right after the smash down, of course, it's the bullion banks that smash it down. Do the rich people a favor. The rich people then come in, take delivery at the beginning of the month. Then the price rises a little bit, rinse and repeat. Again, we're taking gold basically off of the COMEX and sticking it into storage. With silver, we see something similar, although in silver, it's the managed money that's long, though they typically don't take delivery. There's a little bit of delivery for the other reportables. So silver deliveries haven't been quite as high in December, but there is a fair amount of delivery being taken there. And then I've got the long form version of the commitment of traders chart I wanted to show you because there's some interesting information about who has changed positions. Now, this is as of December 1st, so it's basically about 9 days old of data because the commitment of traders report comes out about a week to 10 days after the actual trading takes place, and it comes out weekly. So it's basically about once a week on average. And I wanted to look at silver and see who has made the biggest change in silver. So you can see the managed money has had the most longs in silver as a position group. And overall, the producer merchants have gone the most short. So they're shorting the price expecting, or basically shorting in case the price goes down to protect their position. The swap dealers basically are still trying to dump shorts in silver because I think they have an immense amount of silver position. They're 27% of all silver shorts, that the highest except for the producer merchant. So they're basically trying to get out of their silver short position and doing a fairly good job this month. And the longs are 42.2% long in silver. So if silver price goes up, the managed money, the finance types are going to make a lot of money on their trade. If it goes down, they're going to lose a lot of money. But what is more interesting is gold, because I think gold is where the majority of the metal is between the two metals being taken off in terms of position of trades. And if you look at who's going along, it's the other reportable. So what we see on the bar chart I showed you a minute ago, who's taking deliveries, who's long, 7,000 contracts added leading up to December in other reportables category. So let's break this down. Price smash comes end of November, brings that price down. The rich people in other reportable category, the trusts, the rich entities, the rich individuals come in and take a massive amount of delivery on the COMEX by going long, and they get the metal off of the market cheap. And then if the price rises the rest of the month, they don't care. They can come smash it back down again. So that's who's taking the metal off of the market. In terms of the swap dealers, they did go net short 1,800 contracts leading up to December. So that shows you how the scheme works in gold. Swap dealers short the hell out of it, bring the price down, and the rich elites take it off the market. That's what's happening in the gold market. I think it's pretty obvious. It's basically been what's happening all year long. Nothing new there really at all. Not a big surprise. Same scheme, but that's what's happened in the gold market leading up to and ending the year. I think that will continue in December. We'll see if there's another big smash down prior to January. But I still think gold and silver are challenging their trends. They have bullish technical formations. I think they're going to go up. And I think as we get deeper in the crisis, as we showed you in the first half of this video, deeper into the crisis, people saving, but the small businesses cratering, people having to work more to make ends meet, trying to pay off their credit cards, but also taking on more mortgage debt, more long-term debt, pay off the short-term debt. It looks like people are trying to resolve their finances. But if we get a big economic crash, which I think we will, because overall GDP is falling, overall production is falling, we're in a deflationary environment. When we get that big crash, it's really going to hurt people who have most of their money saved in the stock market and too much money in mortgages where they got to pay back debt. And even though they saved for basically a month in April, basically from April to now, they had basically really good savings dating all the way back to 1960. They're not going to be able to pay off their mortgages, so there's probably going to be more foreclosures coming. We talked about that earlier this week with Nick Bearsheff, how the oncoming foreclosures are going to occur both in residential and commercial real estate. All of those things, and we're going to have evictions, we're going to have a lot of bankruptcies. All of that's going to start to occur in 2020. Really, the only way to protect from that is in gold and silver. The stock market will crash right along with it. The real estate sector will crash right along with it. Gold and silver is what's going to be supporting you and protecting you against this oncoming onslaught. So that's basically what's happened in 2020 with the average consumer, what we think is going to happen in 2021 based upon the data. Till next time, guys, this is Rob Keens with goldsilverpros.com.